Hello and welcome. We had a little, all-in style intro right there. Welcome to episode 13 of the Capital Spotlight podcast with your host, Craig McGrother. And then, of course, alongside Mr. Patek Philippe, suit supply himself, although he's dressed down right now, unlike me, Rob Beardsley, the co-founder and principal of the firm. And with a esteemed and distinguished guest, another Menlo Park Bay Area individual as well. Brad, why don't you give yourself a little introduction?
Yeah, thanks for having me on. So I've been with Lone Star for about a year. I handle lots of our acquisitions efforts. So on a day-to-day basis, I'm talking with brokers, meeting with brokers. We're down in San Antonio now, which is always the fun part, getting the feet on the ground. Get to see these deals in action in person, getting to meet with brokers, getting to really see what's going on in the market. But yeah, generally, it's been great working with both you, Craig, and Rob. And yeah, there's definitely a lot of opportunity down here, and we're just hunting for our next deal.
Yeah. So, and what is your technical title?
So I'm our director of acquisitions.
Very cool. So we have a very, very interesting episode today. So we're going to be talking about several things. First thing I want to go through today, because it's about a year anniversary from the book is actually released. I think it came out around the 17th or maybe the 20th, because that's when the event for the summit was last year. But we're going to go through Rob's second book that he wrote that we teased last episode, which is Structuring and Raising Debt and Equity for Real Estate. So we're going to go through that. We're also going to go through another concept, which is just hard money right now and earnest money deposits as the market is shifting. And also it'll be an interesting perspective with you, Brad, here, considering that we're in three markets, looking through those and how maybe deposits are going to vary in each market, which is fascinating because although, Texas is not necessarily what you would call a small state, but it is interesting the nuances and the differences each market has. And we're going to go through just a bunch of acquisition questions. So a lot of fun stuff to work off of today. But we're in San Antonio right now. Can you give us a temperature check? Not actually how hot it is, but what people are saying, what brokers are saying, and maybe some of that speak before we get into some of the topics?
Yeah, sure. I mean, we're having lots and lots of broker conversations, meetings, tours, lunches, drinks, which is really where the value comes from. I'd say being on the ground, like Brad said, kicking the bricks and really feeling the real estate's really important to get the vibe check, but also just getting the personal kind of stories and the real truth of what's going down is extremely valuable. So it's always interesting to you'll go from one meeting to the next, and we're talking about the exact same deals or exact same markets, and people have slightly different takes where people are saying, oh, well, we're oversupplied. There's actually not enough supply and different things like that. So here in San Antonio in particular, we're learning a lot about kind of the different pockets, where you want to be, where you don't want to be, where there's new supply, how the market functions. And also, like you mentioned, the hard money, some brokers are saying, oh yeah, hard money's off the table. Nobody's doing hard money anymore. And for those that don't know what hard money is, it means an earnest money deposit upon execution of the purchase and sale agreement, and that earnest money deposit becomes non-refundable immediately, and that would be hard money. Soft money would be a refundable earnest money deposit. So yeah, we had lunch with a broker today that said that hard money's gone and buyers don't need to do it anymore. And then we just had drinks with a broker that said that, yeah, we're still getting hard money on deals, but it's a little bit less. So you get these different perspectives. What about you?
Yeah, I mean, I think Rob summed it up pretty well. It's especially for us right now, just being down in San Antonio, it's a new market for us. We have, just started really meeting brokers, I would say, in the last, couple months and things. And so it's a little bit of a different story. Whereas, when we go to Houston, where we already have such a big footprint and, we've been very in tune with lots of the different submarkets, you can kind of have more higher level discussions. Whereas, right now we're trying to really pick brokers' brains and just understand, what's going on in these specific pockets. where do you have concerns? Where are you seeing stronger rent growth? And that's really what's important, because at the end of the day, you've got to understand the area qualitatively as well. The numbers only make sense if you understand what's going on behind them. And in order to make all of your assumptions, it's really just important to have an understanding of the story going on in San Antonio. So yeah, I think it's really interesting, because the market right now is in just it's a tough spot, with where debt is right now. We'll ask brokers where they think cap rates are on, say, just a Class B 80s deal in San Antonio, and we'll get answers all over the place. I think today I've heard 525, 550, 6. So it's an ever-changing market right now, and it's interesting, and you just gotta dig in and try to find some opportunities.
Right. And I guess let's think about this right now. So now that we're in 3 markets, Brad, on your end, underwriting, is it ever interesting how to handicap certain deals if you're looking at 80s in Dallas, Houston, and San Antonio? Now that you do go through that, I mean, you have to be pretty creative and, really individually analyze each deal in each sub pocket, because we're talking about, massive MSAs. It's funny, I just pulled up the population out of curiosity for all respective cities. Houston is the biggest city in Texas, so massive. San Antonio was second, but that's kind of loaded because it says Dallas is number 3 and Fort Worth is top 5, but people usually call it DFW as 1. So it's really called San Antonio the 3rd biggest. People might think Austin is, although it has probably the biggest buzz, it's population-wise not as big as San Antonio, which might be contrary to popular opinion, which is interesting. But how do you kind of mentally handicap this, and also how do we analyze these deals, especially in San Antonio? I mean, does the deal have to look that right for us to want to jump on it if we're going into a new market?
Yeah, so I mean, I would say each market is different in its own way. DFW definitely stands out as being more competitive. So you're going to have right now, cap rates are definitely a bit tighter there. And I think one big thing that we've really started to see develop, even just across, no matter what the submarket is, but there's a growing spread in cap rates between your Class A, Class B, and Class C deals. Whereas, during the height of COVID, you could be paying a similar cap rate on a Class A and Class B deal. It didn't really matter as much what location is, but right now we're seeing much more of a spread in cap rates, and it's kind of going back to where it should be. And there's real risk in the market, and the cap rates need to reflect that. I may have gone a little off track on your question there, but I think it's important to understand what you're dealing with, different characteristics of each asset class, locations, and just understanding the risk involved in each deal.
Yeah, and I think, Rob, you had a really compelling snippet that you wrote out, which I want to get into at some point, maybe deep dive perhaps next week, specifically pertaining to this subject right now, where a couple years ago there was a very, very minor delta in Class A and Class C almost, which is nuts to think, and now that's spreading, which is good, but very concerning if you were the buyer of the B- C+ asset with a shorter term debt note who's coming due perhaps in the next 18 months, 24 months. That is not a situation I would want to be in for sure. And there's gonna be a lot of people facing that. So we hope that those people are okay and, figure out a solution, whether it be bridge to bridge or, figure out a way to preserve investors' capital, because that will definitely be present in the marketplace with sellers that, unfortunately maybe aren't able to make a capital call or need to get away from the property. So it's certainly concerning. I really want to go back to this real quick. I think we kind of glossed over it ever so slightly, but hard money and earnest money deposit currently. So from about a year ago to today, what have the differences been in your guys' opinions on that side?
So as I made the general comment about brokers saying that some deals are still getting some hard money, some brokers are saying that hard money's gone. It's wherever you are, it's definitely pulled back. So at the height of the craziness and competitive bidding processes, you might see for a $20 million deal, $500,000 earnest money deposit that goes hard day one. And that's over 2% of the purchase price. So I'd say a 2% hard money deposit is very aggressive. And that might scale back in a competitive market to 1%, or maybe to 0.5%, right? Or maybe they just want a sliver of hard money. So maybe the deposit is 250K and only 50,000 of it is non-refundable day one. And that's kind of where things are pulling back to. And so sellers want certainty of closing now more than ever, because if you look back 18 months ago in a very hot market, sellers were less concerned with certainty of closing because they had the confidence that if that buyer fell through, great, they would just take the hard money, move on, and probably sell the deal for a higher price even than what they were under contract for, because prices kept going up and up. So it's a win-win, right? You keep the hard money deposit and you sell for more later. Now,
God forbid, yeah.
yeah. I mean, actually, we have an equity partner that was an LP on a deal, and they actually went under contract, fell out, kept the hard money, went under contract at a higher price, fell out, kept the hard money, and then went under contract a third time, and then it finally closed. So along the way, they were keep getting higher prices and they were keeping deposits. So that was the reality of the market. And now I think at least wise sellers have a strong, healthy fear that if they don't transact today and they have a desire to transact in the near term, they're going to sell for less if their deal falls through, right? And no matter what market you're in, there's a stigma associated with a deal falling through. Why did it fall out? Is there something wrong with the deal? What did those buyers find out? So you never really want a deal to fall out of contract, but it's happening. And Brad is in the trenches talking to brokers, and he's hearing of deals come back around, and also a ton of deals are getting retraded, right? Brokers are telling us every single deal we're working on right now is getting retraded. And we talked about, I think, retrading on last week's show.
Well, interestingly enough, I just spoke with one of our big equity partners as well, and they were saying how similarly to something we've experienced, way worse in their situation, but the lender, even after they rate locked, retraded them a full 100 bips up, which naturally, if they can't accommodate a retrade, the deal is dead, and no one wants to have that happen. The lenders won't have that happen because then they just wasted a bunch of time on something they're not going to get paid on. No one is thrilled or happy about that experience. So, it's a brutal time in a choppy market. And there's obviously light at the end of the tunnel. I think we're probably halfway through this period of uncertainty. And, I'm personally and mentally banking on rates getting hiked one more time. And if I'm wrong, I would be very happy to be wrong, but that's likely the reality that we're going to experience coming up to these points. And we're probably, coming closer to the end of this segment in brokerage, but it is definitely a scary time as we navigate through this entire process, which is interesting.
So I want to hear from Brad more specific, like real numbers. What are we bidding as far as hard money? What terms are we bidding nowadays, given that kind of the power has shifted from sellers to buyers?
Yeah, so I mean, I would say right now we're not at more than 1% in terms of earnest money, and we are, we have some deals where we're putting in LOIs soft, and I think right now, if anything, it's really, as Rob said, it's just becoming less and less important. And what brokers care about is, I mean, we are fortunate to have a strong reputation, and they trust that we can raise equity, and they that's what matters more than hard money, because if somebody needs to sell and say they're on floating rate debt, they've got a loan maturing, they've got a rate cap that they need to escrow for, they can't just keep kicking the can. They don't want to take hard money, and especially when hard money is light right now, they need a sponsor that can close and get it done. They don't want this to be dragged on forever, because it really just hurts them in the long run. So right now, even just price is not necessarily going to win you a deal. I've heard multiple stories, this is across all markets, where there have been bidding processes where the majority of groups are coming in, say, at 25 million on a deal, and then one group is coming in really aggressive at, say, 27, and they're getting awarded the deal, but they can't close. And at the end of the day, it's frustrating for brokers, frustrating for sellers. Nobody wants to deal with that. It drags everything on. And so brokers really are getting tired of that, understandably, and sellers are as well, because not all of them, but if they are selling right now, there's a good chance that it's because they're in a little bit of distress. Their debt situation is hurting them. They may be trying to avoid a capital call. So I think that's really the biggest change we're seeing right now. But going back to just what we're doing, I mean, I don't think we're really putting down more than about 150,000 hard money in our projected terms, regardless of the deal size. And it's just, on a percentage basis, it's not that significant a lot of times. And it's really just to show a little bit of something, just a little bit of skin in the game. If we walk away from the deal, it's still, we feel that strengthens our position a little bit, and brokers like to see that, sellers like to see that. So we've definitely dialed that back a bit. But yeah, that's kind of where we are right now.
So from what you guys have said, from the inside, from the boots on the ground, it sounds like as if certainty is more important than anything else right now, the certainty of close and predictability juxtaposed to highest price. Is that correct?
Yes.
Okay, gotcha. And from 6 months ago, where were we before? I mean, we're talking about 500K, basically, 2% roughly. So we're talking about basically cutting out half, even to a third now from where we were basically a year ago, 6 months ago, correct?
It's definitely longer than that now. It's more like 12 to 18 months ago, at least. Yeah, more like 18 months ago now.
Right. So it's so slowly but surely shifted over. And I guess market per market, is that different? Because I know, Dallas still has best and finals. Houston is not necessarily at that point. San Antonio, is there still multiple bidders? I know San Antonio, if I'm not mistaken, has a little less velocity than people would think. And compared to Houston and Dallas, meaning less velocity, less turnover of units. It's usually a little bit longer holders of the assets. So where does San Antonio fall on that line?
So, I mean, I would say, I don't know. It's kind of, as San Antonio, it's hard to give a definitive answer on that, just because we are still learning the market. And as you said, we've probably seen maybe, 40-ish deals or so at the most. And we haven't really seen a lot go full cycle yet and go entirely through the process there. So, it's a good time to learn the market, and we're hoping a little more comes out. But sorry, can you repeat the rest of that question? I know you mentioned San Antonio.
Just, the difference between San Antonio, Houston, and Dallas with regards to earnest money. But if we don't have enough sample size, we can probably just bypass through. That's not a problem. It sounds as if it's, roughly in plane with the other places. Switch.
I don't think that's one aspect that I think is fairly similar across those markets right now.
Which is surprising. given how competitive DFW still is.
Mhm.
So you would think that people would be trying to differentiate themselves more with hard money, but it really has shifted across the board. But like you said, Craig, DFW is still getting a ton of bids. And actually, we were going over a deal today in San Antonio that had 20 bids.
Mhm.
So for the right deals, there's still a ton of bidders out there, but it's where are the right deals? There's not that many of them that are priced well and that are financeable, because that's just interest rates are affecting everything across the board.
Right. Awesome. Well, switching gears now away from the earnest money and hard money conversation, which is fascinating. I think it's really useful for anyone who is looking to kind of get a sense for the ins and outs and kind of the nitty gritty for an operator. I think that question is really useful and something to think about if you are looking to tackle these projects yourself and you have the bank sheets and the experience to do so. And you're going to be an agency player. These are really important things to think about as you look to take the risk and look to acquire assets. But Brad, a question for you, working with Lone Star, what's your day-to-day like? You do so many things with regards to your job, underwriting, analyzing, speaking with brokers, pitch decks, making sure the information's in there, getting pestered by calls from me, wondering about, what the other income in the property is and, how that works and the fundamentals. But how do you kind of balance your time? What are your roles? What do you do in the day-to-day?
Yeah, so I mean, I would say one of my favorite parts about this job really is that there is a lot of variety in what I'm doing. A lot of my time is spent underwriting and looking at deals. But I would say, I spend a lot of the day on the phone as well, talking with brokers. If I'm not traveling down to Texas, if I'm back in New York, just on the phone, checking in. It's really important to stay in touch with brokers and stay top of mind, so that if they're saying, hey, I've got this deal coming out soon, I'll send it to you right when I get financials, things like that. It's just really important and from a sourcing perspective to really stay in constant contact with them. So yeah, really a lot of due diligence and things, just whether it be, digging into underwriting, say we're getting closer on a deal, might start calling around to comps, doing a deeper dive on the specific area, maybe consulting another broker, for example, getting a debt quote, getting insurance quotes, talking with our property management, as well, talking with our asset management. One recent initiative that I think is really helping us out, is we're pushing forward kind of a project to quarterly we want to do a review across our whole portfolio of what expenses are costing across our portfolio. So how much are we paying in payroll for 200 to 300 unit deals across our portfolio, 100 to 200 units, and then the different nuances with all of those. And so that's really important, because you need to keep your underwriting updated and know that if, say, we're gonna underwrite that our marketing expense is going to be $250 a unit, we need to know that that's a legit number and that that's actually what it costs right now. Because at the end of the day, we don't want to get burned. And the way that you can really grow confident in a deal is just to really flush out all of your assumptions, and that's how you can feel most confident to move in on everything. But yeah, and then moving just kind of beyond that, we're talking with our debt brokers, and trying to get debt quotes, staying really on top of the capital markets, seeing what are the best options for deals right now, is really important, especially just right now. Treasuries are unfortunately changing week to week, day to day. And then, yeah, on the other side of things, when we have deals that we are fortunate enough to put under contract, just working to, prepare those materials, make sure our decks and things get ready. And yeah, so I guess just the last part, not as big of a part of my day to day, but every now and then, I'm lucky enough to get a call from Craig. And if investors have questions, need to know more about the specifics of a deal, things like that, always happy to help. And just making sure everything's squared away and that everyone can understand the deals. We have some much more sophisticated investors who like to ask lots of questions. And so just being able to give them all the answers they need. Yeah, I'd say that really.
Well, let's say we also have some sophisticated investors who don't need to ask a lot of questions, and those are very nice.
Yes, well, and everyone has a different understanding. You get some $50,000 check writers who will ask a zillion questions and then no questions. And then you'll have people who, drop a couple $100,000 off and not question anything because they have full trust in you. So we understand that everyone's different. It's not a perfect science, but the kind of comment and takeaway that I had, which is so impressive about what you're doing and how pivotal your role is in the firm, you basically are the gatekeeper to everything, Brad, because without you looking at these deals and pushing them through, then I don't raise for these deals. Rob doesn't put his 2 cents on it with the final underwriting and stuff. And then generally speaking, it's just crazy what you mentioned with how fluid the process is. So the fluidity is nuts. And that's with, the quarterly reporting of, kind of the efficiencies with the amount of unit counts, what cost should be. I mean, getting those numbers down and getting that precise, to your point, can get us either over the hump and make us feel comfortable or make us back away. So should information and data change on that is really going to shift our opinion on a property, which I think is so interesting and also inherently dynamic as everything is shifting. And then also, and another interesting thing too is, what does it look like across the different markets we're in as we're going to add a big portfolio in Dallas and hopefully start to accrue one in San Antonio? Well, those numbers and hourly pay might be slightly different, or there might be certain different wrinkles in said markets that will vary across the board. That will be super fascinating to track as time progresses. So that's a really my thought and takeaway was just getting really in the nitty gritty is super important, and on our end is very much so on brand and on par for the Lone Star way, which is smart things with smart people being sophisticated, which is awesome.
Let me jump in with that point, because especially now with expenses and everything changing so quickly, it is really valuable to be updating every quarter, like Brad said. And I think a lot of firms like ours struggle with having the underwriting and acquisitions speak to the asset management, right? They're kind of off on their own, doing their own things. The asset management team's running the properties, the acquisitions team is hunting for new deals, and then it's hard for them to connect. And so we're making a concerted effort to actually deliberately connect and to have a flow of information that's two-way, because the asset management team obviously can inform our underwriting in a big way. We can know up to date, what is marketing? How much should payroll be for this deal? What do we think about security, et cetera, right? There's so much that can flow that way, but then also acquisitions can flow to the asset management, because invariably by us looking at so many deals and sifting through other owners' P&Ls, we can pick up other nuances about, oh, well, it's interesting, this property is doing bulk fiber internet. All right, oh, this is a good strategy. Let's actually take that and apply it to properties that make sense in our portfolio. So that two-way conversation can be valuable both ways.
Well, in addition to that, I think I've also stated what some of our investors and capital raising partners are looking for as well. As I mentioned, right now, there's a big emphasis on cash returns. So maybe if there's a deal that's really close, that is cuspy, well, hey, I think this deal is a little bit light on cash, which makes me not want to be so aggressive. Or on the contrary, wait, I actually think I can get this deal to an 8.5% cash return. And we're already now paying down, the pref, and we're hitting that deliverable there. Maybe that's something that's really compelling for the next 4 years. But then in 2 years from now, it might switch to the equity lift where people don't care as much about the cash return and opinions will change. So as the market ebbs and flows, as we do, us being so connected and so tight knit and lean is very, very beneficial. So something to think about, to piggyback off your point, Rob, that, it's all really good that we're in lockstep with one another, and we are collaborating and constantly in contact, and are sharing and trading notes. And then, of course, as you mentioned, looking at other people's P&Ls is kind of a fly in the wall cheat sheet to see how they're operating, assuming they're telling the truth, of course.
That's right. Yeah, it's a good point that you bring up about, here's acquisitions, and then it's speaking to asset management, and then acquisitions is also speaking to investor relations and figuring out, okay, well, what do investors want? Because obviously our business is centered around serving our investors. And so we aren't just doing acquisitions for the sake of it, we're doing acquisitions for our investors. So why not hear from the horse's mouth what we should be acquiring? So I think it's good that we're all talking in that way.
Yeah, absolutely. Next question for you, Brad, is how many deals you typically underwrite in a month or a quarter? I mean, naturally, if we're doing a big raise, or if you're a little bit more time constraint or time restricted, it's difficult. But on average, maybe deals a month, a quarter. How many deals do you look at?
So I would say, it definitely ebbs and flows, just with the market and what's coming to market. I would say the goal is to look at about 10 deals a week. So I guess about 40 or so a month. And, I think one thing that's really been helpful for us is we've just narrowed our scope of what we want to look at, and really just trying to work smarter, not harder. In that sense, just because for a while, I think, if you get too tied up in just saying, hey, we want to look at 20 deals this week, but in reality that 15 of those you would never buy because they're in, junky area, or, have chillers, things like that. It's, you're making yourself feel good, but in terms of the actual output of, what's productive for the firm, what's the best use of everyone's time, it's kind of better to, narrow that buy box, narrow down to what our investors want, as we were just discussing, and just to have a better sense of direction for what we want our portfolio to grow into and what kind of properties we want to own. So yeah, I mean, it definitely can fluctuate, and I'm very sure that if interest rates fall, that number is going to rise. But I look forward to the day where I get slammed.
I look forward to that as well, frankly. I think the whole market.
We're all looking forward to that. So, and let me take a step back and just talk about growth at a high level, right? So what are the ways to grow your AUM, to grow your acquisition volume? You can buy more deals, right? You can buy larger deals. And then, so that's really it. You can buy more of them, or you can buy bigger. And then how do you buy more? Because bigger is self-explanatory, right? You just do a bigger deal and raise more equity. How do you do more deals? Well, you can either look at more deals, or you can have a higher conversion of the deals you're looking at. So classically in real estate, people say that you need to look at 100 deals to find that right one. And then we've kind of experienced in more tough times, more like 200 deals to buy one. But what Brad is describing is our desire to really turn it up a notch and go the opposite direction and look at 50 deals and buy one. And that requires being very efficient, being very intentional, and narrowing down our buy box. So that way we can pre-screen and disqualify deals without investing a lot of time. Because let's say we're stuck and we're only allowed to look at 10 deals per week. That's it forever. And if there is more deals that come to market and Brad is slammed, then we need to tighten up our buy box. And that way we're still looking at 10 deals, but hey, can we, out of the 40 deals we look at per month, can we put one under LOI? That would be tremendous, right? Instead of having to put one deal under LOI every 3 months. So that's really the goal, because it's a lot more fun for us three to be doing a bunch of deals rather than having to hire way more people and just having like this sweatshop of just crunching numbers all day and looking at hundreds of deals.
Yeah, I think as a firm, that's not really what we want to do. And Rob, you've spoke to this before, but we want to keep it lean and efficient. I don't think we have the biggest aspirations to be, hey, I'm going to be the biggest real estate syndication firm. I think we just want to be the best, where people are begging to get into our deals and begging to give us money, and we kind of choose who we get to work with. And naturally, we want to have many billions of asset under management, of course. That's everyone's goal, but I don't think we have aspirations of being, we want to have 100 billion under management and like that. That's not really who we are. That's not, I think, in our DNA. We want to be sophisticated, lean, and only have the best partners, and, attract the right people that are the right fit for us, which I think is a really cool premise to kind of brand ourselves in a very niche and luxurious and a high-end way. While we're buying, maybe not the sexiest looking properties, but we'll make it sexy.
Well, I think 5, maybe 10 billion. That sounds about right. That's reasonable.
If you insist, I will be happy to make the phone calls. With that said, how many LOIs are sent out a month or a quarter? So if it's about 40 deals a week, which is about, call it 120 deals a quarter, how many LOIs are being sent out?
That's a good question. I would say it's maybe roughly a 20%, maybe a quarter. Just because, sometimes I'll call a broker and, give them pricing feedback, and they'll just take it down as, verbal. This is your verbal offer. They don't need an LOI. And sometimes when, we may be really far off on a deal, but a broker still appreciates having an LOI because they can show that to a seller, and that can help set expectations if they need pricing to come down. And that's one thing that I think, can be really powerful, especially just establishing relationships with brokers, because if you can help them please sellers, it strengthens the relationships. They like working with us. They know that they can get honest feedback. They know that, we're constantly monitoring the market. That's really important. So I would say, it's the number of LOIs can really fluctuate.
How about serious ones? Because with that said, it's so funny. I was about to ask you, how do you ever just throw brokers a bone just to make them feel good and to make them do their job and report back to their clients? Because I have had the situation where I've thrown in offers for people where I know the offer is not getting accepted, but as a good buyer's agent in my previous line of work, I will just do it to accommodate all parties and to, sometimes help the buyer realize that he's high. Or, I've had some sellers where we basically had soft, hey, we'll come in roughly at this number. If you want me to put it in writing, let me know, but they tell me to not, but just to, help massage potentially a price reduction due to, someone being there. So I guess more formal, like legitimate, hey, like we're serious about buying this one. If you said it's about 20-25% there, is it basically that cut in half? Would you say maybe 10%?
I'd say it's
at the most.
Yeah, at the most.
So then we're talking about roughly about in today's market of 2023 in September, we're talking about 8 to 12 LOIs a quarter that are serious.
Yeah, just
Probably
about
around there. Yeah.
Yeah, and it's lower right now because just things are wide. There's a big bid-ask gap between buyers and sellers, which we've talked ad nauseum about. Sellers are on this show and everywhere. We're having conversations every day. We're all broken records at this point. Everyone in real estate's just in a psychosis, and we're all waiting for. Yeah, I joked today with a broker. I said, yeah, you must be working twice as hard and making half as much, right? Because, oh man, we're doing all these BOVs and all this stuff. And he said, half as much, we're not making anything. There's hardly any deals getting done, right? And on a national basis, people are quoting transaction volume being down like 70% or 80%. And I think that's pretty spot on and in our industry as well. And, some brokers are saying it's more like 90%. So
I'm having a record year, said no one ever this year.
Yeah, pretty much, except our friend Johnny Walker said that he's raising more money than ever and he's crushing it, so he's doing amazing with
That's
his.
because he's got the juice. He's the man, and I expect nothing less from a big G like him.
Yep, he's got the dentist on lock. He's doing super well. So
People need their teeth fixed in any market, right?
if you yeah, I mean, if you have a unique business that's kind of growing like this, it's certainly possible. But yeah, you're right. I mean, it's a very tough market, and so
Well,
the
think about
LOIs that we're putting out are really mostly for kind of educational purposes, if you will. And also, it's good to have an LOI sit there because you never know when that seller is going to capitulate and finally give up and say, all right, I know that 30 million is not realistic. I know that everyone's coming in at 24. Fine, let's pick up the phone and call the best of the 24s, right? And if we didn't have our LOI in there ready, then we're not going to get that call. So it's all about timing, and never hurts to have an offer in.
Well, it's like a Hail Mary. You just hope Aaron Rodgers is throwing the ball. Maybe not last night, but you just kind of hope that you throw it out there and you put a good look out there. And just because you throw an offer out doesn't mean it's going to get rejected every single time. And sometimes that's kind of what the market is. But you want to talk about the growth subject. And it's crazy to think this, but we're at about 350 millions of assets under management. Within the next couple of months, should things go our way, we might be closer to 500 million, which sounds pretty crazy. Yes, sounds pretty crazy to say out loud, but that is a substantial gap in difference between the two, 350 to 500. So we're hoping to be there by the closing out of the year, and that's awesome growth to that point. Moving on to the next question, how much time do you go through analyzing a deal at this point? If we do have these really hard buy boxes, is it a 20-minute endeavor where you look at a couple of things, you say, oh, no, that doesn't work? Or is each deal like a 2-hour exercise for you? Because I imagine for someone like myself or someone who's not as experienced, they can't churn through this as quickly. It's probably, very, very slow, maybe like watching paint dry. But for a pro like yourself who does this all day, I bet you could probably disqualify this a lot quicker than the average person.
Yeah, I mean, I would say that there are times I would say the biggest disqualification right now is just right off the bat. If we can see that it's going to be some enormous lift that's going to require, say you have a 50% occupied property, and the only way to really get it done is through bridge financing. I'd say that's a pretty easy way to rule out deals, just because we're not willing to use any bridge debt right now. Everything we want to do has got to be agency financeable. And we ideally want to get to 60% LTC at least. So I would say, there are different ways to rule deals out, but for the most part, try to give each of them, a good look, because we can disqualify deals, say they're chillers, it's in a flood zone, it's in a rough location that we don't like, then right off the bat, I won't even look at the financials if that's the case, if it doesn't pass our initial qualitative test. But if we're really, really, really digging into a deal, it can be up to 5 or 6 hours, if you're digging in, first looking at Yardi rents from comps, then looking at website, calling, trying to dig in, seeing, hey, who's charging fees? Say there's, one comp is charging 1,200, but they include washer dryers and all these amenities in their rent, and we're trying to, tack that on. That's important, and tack that on in other income. That's important to factor into what we charge on our market rent. So really digging into those details when we find something we like can really make it a longer process. And then finalizing debt, going to property management, and just getting their approval on the underwritten budget and things. But I would say on average, you can do a pretty solid quick and dirty in about 3.5 hours or so, something like that.
So 3.5 hours you'll know, but
Maybe
and
three. Yeah.
and that's if the deal checks the sniff test, correct?
Yeah.
Yeah, assuming that the median household income looks good and that it doesn't have any red flags, like we're not doing chillers or coastal properties or properties in flood zones. So obviously that takes only a few minutes to figure out if it has any of those red flags, but assuming it doesn't have those red flags, then you do have to go through a full process. And people ask me all the time, oh, what's the way to do napkin underwriting? I just want to do it faster. And there's no cheat. You can't just kind of do a quick 1% rule and
Underwriting a single family house where it's very rudimentary, very, very down the fairway. It's very, very, hey, well, this house sold for this price. It should praise around here. These are the 4 rental comps. Yours is kind of in the middle. This is probably a rough range. Okay, cool, great. There's really no more discussion there. These are very, very sophisticated inputs, and we don't want garbage in and garbage out. And there's a lot more that goes into this than the average thing, or the average I guess, underwriting process.
Yeah, if you're gonna do garbage in, you're gonna get garbage out, and there's just no point, right? There's no point in doing a quick and dirty underwriting because it's not going to be insightful. So it does take that extra push, and it's a fine line because time is a resource in our business, and you can't spend 6 hours on every single deal because there's not that much time in the week. That right there would be 60 hours of work right there, and you can't do 60
At
hours.
least 2 employees. Yeah.
Yeah, you can't just yeah, it's not a good use of your time. So ideally Brad is underwriting maybe, I don't know, 20 hours per week, 25 hours per week, and then the rest of the time is spent talking to brokers, working on pitch decks, handling investor questions, due diligence, capital markets, debt.
I mean, kind of thinking about this, you got to be laser focused to your day to day, because you get called from one direction, then I'll call you to ping you about something. Then you got to go back to your spreadsheets. Then you got to fix maybe something on a memo. So you really get pulled in so many directions, and there's only one of you. So I can appreciate that, because sometimes I'm calling for various activities or going through different messaging and stuff, and it can be a lot, and I get a little scattered brain. So I hope your focus and your ADD is a little bit better than mine.
Let me add one more thing too, because I think Brad and I have recently made a nice improvement over our previous strategy or way that I would manage the acquisitions team. I would previously manage by basically, we would have a list of all the brokers that we would want to be in touch with, and I would just have the acquisitions team or Brad just check off who was spoken to. If that person was spoken to this week, then check it off. But then it's now I have to check and I have to see, okay, well, who did you talk to this week? Oh, well, you didn't talk to them last week. You should talk to, it's too much. So we've simplified it. And I think generally speaking, batching your activities is a much more productive way to go. So with Brad can speak to this, but we've gone to this more of like a call sheet structure where it's just, all right, on Mondays, I need to call down the list of brokers. So that way you're kind of sitting on the phone all day, calling, rather than you call and then underwrite, call, and
Time blocking, yeah.
There's switching costs, right? So I don't know if you want to add anything to that, but I think that's been a big improvement.
Yeah, definitely. I mean, I think being organized is critical, because as you said, it's tough if you're constantly bouncing around and then it feels like you get nothing done. If you're trying to do a little bit of everything at once, it feels like there's no progress being made. So yeah, I mean, as Rob said, really just trying to time block, and it works. I would say it's effective, but there's nothing stopping a broker call from happening on say Tuesday through Thursday, even though I try to block out time on Monday. But that actually is for the better.
We all know that call's not happening in this market on a Friday, because they're all probably golfing or having a beer at noon. So you definitely want to front load that on the Monday, I bet.
Yeah, exactly. You learn your spots, especially in the summer. Friday Friday's not the best time to start dialing.
Absolutely.
But yeah, I mean, in general, it's become a pretty natural process, and you just you talk with brokers when they have deals. It's good to just check in. And so I really just time block for use that as a time on Mondays to say, hey, I haven't talked to Colliers in a while, for example. That's just a random example, but it's good to check in with them. It's you want to stay top of mind, as I mentioned earlier, and just keep your finger on the market, always know what's going on, see where deals are trading. Yeah, I think that's really where you can extract the most value.
Cool. Next question is, outside of price, what are things that make a deal not work or work in this market? So I think you mentioned a couple of things, which was, depending on the location, outside of the automatic no's, which is, obviously flood zone, if it's coastal, boilers and chillers. What are some things that will make a deal work right now? And what are some things that will make a deal not work right now?
Yeah, so I mean, as I mentioned earlier, we're looking a lot at our going in caps right now. We need, really probably a mid to high 5 cap going in right now, just with where debt's at. And then building off of that, I think we're really looking at our stabilized yield on cost as well, and our cash flows, especially right now. You're competing with treasuries and things. People can get over 5% on their money doing absolutely nothing, just in money market funds and things. And so that's really been something that we've honed in on a bit more. And we really, if you can look at your cash flow, you protect yourself from your exit assumptions, which just naturally are a bit more challenging to make right now with how volatile the market's been. But yeah, I mean, I would say in terms of metrics, those have been pretty important to us. I don't know, Rob, if you have any more to add on that.
Loan assumptions are a way to get a deal done, and obviously everything gets back to price, and there's a price for every single asset that makes it a good deal. So price, it really does reign supreme, and I'll get back to that topic, but specifically on loan assumptions, the challenge with loan assumptions, well, let me talk about the good about loan assumptions. Obviously, everybody knows that the good about loan assumptions is you could step in to an existing loan at a low interest rate. And that's fantastic because market interest rates are very high. However, the problem is, and I think we discussed this on maybe a few episodes ago, the fact that price is permanent, but financing is temporary. So if you can buy a deal today and the numbers pencil because it's a loan assumption and you get cheap rate, well, eventually that loan is going to mature, and then you're going to have to refi that loan into a loan with a prevailing interest rate. And that could be much higher, and that could blow up the deal. Or you could decide to sell at that point, and pricing could be unattractive, and so you're not going to make any money on your sale. So people rush and get excited about loan assumptions, but I honestly don't know if I love them. I think
Loan assumptions are equivalent to the seller carry or seller financing, creative financing in the residential real estate world. It's kind of funny. It's those things very much so marry or go together, and it's easier said than done. And when there is a situation like that, usually there's a premium associated, it seems, to get it done. And yeah, obviously, as you mentioned, you get yesteryear's rate potentially on a loan assumption, but at what point, at what cost, and what's the term like?
Right. So I would probably rather pay a lower price, suffer with higher rates, than pay a high price and get the benefit of low rates. But it all comes down to your underwriting. Both can totally work. But yeah, that loan assumption is one way to make the deal pencil. And then we're not going to get too far off topic here, but I'll just throw in one teaser, which would be affordable housing strategies are another way to make deals pencil, right? And so you can do that with bond financing, property tax exemptions or abatements,
Okay.
nonprofit partnerships, low income housing tax credits. So that's a whole nother world, and that's another separate asset class completely to market rate multifamily housing. But that is a way to get creative and see deals the way that the market's not seeing, and kind of generate some alpha, which can overcome just the difficult dynamics of the market.
So outside of numbers, outside of cap rates and debt, is there any physical attributes to a property that make it like, okay, well, this does make more sense now because there's a little bit more of a story here to be told? What would some of those things consist of? Would it be higher ceilings? Would it be maybe the year it was built? I imagine anything older than 1980s. Right now, you really, really, it has to be well appointed with probably no supply coming to the area for us to feel comfortable about it, with some original units, just because we could bump it up. But what would be some physical characteristics that kind of get your juices flowing?
Yeah, so no, we really don't want to deal with, as you said, 70s, 60s deals right now. Want to move away from classy, kind of junkier deals, if you will. So we want to see pitched roofs, no chillers. Chillers are a huge pain to deal with and very
Explain what that is, by the way. We talk about it, we know what it is, but can you explain what a chiller is, just for people that might not know what that is or might not be familiar with Texas, or just and any that grade and era of construction and I guess appliance?
Yeah, I mean, Rob, you might be able to explain. We've been ruling them out since I started, so I haven't.
Yeah, no,
directly
we've
dealt with them.
we've actually programmed.
You just know it's taboo. Yeah, it's like, oh, I don't want to hear about it.
Yeah. He's blocked it out of his brain. But yeah, a chiller is a master appliance that provides cold. It's a way to power the central air for a property, and it is very expensive. They break down. It's a big one-time capex if you do have to replace them. So that's why we want to avoid them. So we've had to replace them in the past, and it's something that we want to move beyond if we can have the luxury of doing so. Certainly you can bake it into your numbers and you can make money by owning a deal with chillers, but from our experience, it's just kind of like, hey, let's sleep better at night. So that's one thing. And then boilers are similar. It's how you provide hot water to the units, and they're actually not as bad. So we haven't ruled them out completely. So that's kind of where we are with those elements. 9-foot ceilings you mentioned are very attractive. I think that is a big differentiating feature of what could be a B plus property versus C. It's impossible for a C asset to ever, I'm sorry, it's impossible for an 8-foot ceiling deal to ever be a B plus deal, right? You can renovate it fully, put all the premium appliances in there, and you will never get there. So you have more headroom with a 9-foot ceiling deal.
Okay. Any other physical attributes that should be mentioned while we're on that subject?
Yeah, you also mentioned vintage. I think that's kind of an obvious one that people it's one of the first things you mention when you bring up a deal. Oh, it's this many units and it's this vintage, right? It's built in 2001. It's built in 1976. And so I think vintage isn't set in stone, or what I mean by that is there are 1970s deals that have all the attributes of a 1980s deal, which would make it attractive for us. So it's not, the number isn't a set in stone figure, right? We will buy 70s deals if they check the boxes that we're looking to have checked. With that being said, raising equity is more challenging by the number, because you will 100% scare off certain equity investors if you say that the deal is a 70s vintage deal, an 80s vintage deal, even a 90s vintage deal, right? Their equity groups have all have their own cutoffs, and there's nothing in certain cases that you could say to convince them otherwise. You could have a 80s vintage deal that's 9-foot ceilings, pitched roofs, individual HVAC, and an institutional investor could say, sorry, no, we only do 2000s or newer.
Yeah. Gotcha. Any other final comments on that question?
Yeah, I mean, I don't know. I think Rob covered most of it. It's, at the end of the day, you want to just be aware of what kind of deferred maintenance and things you're going to be dealing with. It all comes down to price and just being aware of what your CapEx needs to be, what you need to be budgeted for. But yeah, nothing else really.
Well, how far off are most deals that we look at from where we'll pay for it? Like, I mean, is it 5%, 10%? Is it a couple percentage points, which is, massive on the acquisition of it? Typically speaking, what's the bid ask spread, would you say?
Well, the funny thing is what is the ask? Because people are whispering anything, and the whisper is not a firm thing. If you rewind to the crazy days of 2021, early 2022, the whisper price was kind of the minimum price to get your foot in the door to then participate in the bidding process. Now the whisper price is this huge high bar that nobody's getting to. So deals were trading above whisper. Now deals, if they're trading at all, are trading below whisper, and people are throwing anything out there. So I think it's really hard to kind of pin down that bid ask spread, because it depends on how realistic that whisper price or that ask price is, because it's all over the place. So I think a more maybe interesting thing to ask is, where are sellers actually willing to sell for? And then where are we coming up, right? Because at the end of the day, if they're asking for 30, but they're willing to sell for 26 and we're willing to pay 24, okay, that's actually, we kind of got to the bottom of things, right? We cut out the noise, and now that's actually the real gap. So I would say on paper, the gaps can be 20 to 30%. I mean, we don't even want to talk about some of the ridiculous asking prices that we've heard. It's just silly. But you get to the bottom of it, you have a realistic seller, I'd say the gap is still probably around 10%, maybe even higher in some cases.
Wow. It's crazy. And then finally, I wanted to ask, how has dialogue changed with brokers from the last year? Because I imagine it's been pretty substantial, where people are, a little bit high and mighty on their high horse with the power of, having the listing. And now with things changing, and everyone kind of eating a slice of humble pie throughout the industry, what's dialogue been like? I guess maybe specifically since H2 was started, second half of the year, and I guess just from when you kind of started over a year ago.
Yeah, I mean, I think one of the biggest differences really has been, as you said, when the market's hot, it's a seller's market, and the brokers kind of justifiably are a little bit high and mighty, if you will. And now I would say, with a lot less transaction volume and deals, not as many deals closing, I feel like the tables have turned a little bit more to where I'm having lots of conversations with brokers where they really want to just understand, it feels like more than ever, what we need, what metrics we need to hit, what we're looking for, how can pricing make sense for us, because it's getting to the point where, as Rob mentioned, a lot of guidance pricing and things it's not really real, and it's not where the market is. But I think there's a fair amount of discovery that's starting to happen in the market. And if you have a marketed deal where the seller is going to meet the market, that's where you can really see the true value of what deals are worth right now. And so I think, ultimately it's just an evolving market, and just with debt, and how cap rates have changed as a result. But I would say the biggest part really is just that their willingness to listen and just kind of understand where we're at, because we're not alone in having our pricing come down dramatically. I mean, we looked at a deal about a week or so ago that we were valuing it at about low 80s a door, and last year we submitted a bid in the low hundreds. So it's pricing is changing, and it's just as we said earlier as well. We asked brokers where they think cap rates are on an 80s Class B deal in San Antonio, and we got some answers that were all over the place. So it really is, the price of an asset is what somebody's willing to pay for it, and so they want to learn from the buyers as well right now.
Yeah, and it's always a dancing game and an important act to do, because if you do well as a broker, not only because most things in the commercial world are double-ended, basically everything is. So you want to make sure that you do right and you're not lying through your teeth as a listing broker, because that buyer, if you do a good job, will work with you on the back end to sell the property. So of course, everyone's trying to massage everything for their client's best interest, and there is some fiduciary issues and aspects that come in with double ending deals for many reasons, of course. But at the end of the day, trust is really important, and making sure that we're all consistent together is very, very important, and something to think about on all ends of the the process and the buying and selling side. I guess just a couple more questions. Brad, what has been your favorite part about working at Lone Star Capital? And then I have a couple more outside of what was on script.
Yeah, I mean, I would say, as I said, just the variety in my day-to-day work, I really enjoy, and it's a good balance for me. I feel like it really fits my personality well and things. I get the chance to dig in on deals, and very, very analytical thinker, and have always liked working with numbers and things like that. Excuse me. But also really enjoy just getting to talk with people, getting to meet brokers, and we have a great team to work with as well. It's really cool just to see that everybody, we're lean, and everybody is really good at what they do, and I think everybody's skill sets complement each other really well. And it's just exciting to see the potential for what we have in store here.
Yeah, absolutely. Very, very predictable and diplomatic, and solid answer on your end, which I expect nothing less. I guess something, because I really want to talk on, because I've gotten messages from people that are in college that listen to the show, whether it be their universities and in their respective clubs. People are maybe looking to make a transition and career-wise. What do you think some of the biggest things that you learned, and what would maybe your degree in college, if people might care about that is applicable to what you're doing right now? But what are some things that people need to understand and know if they want to be really, really successful at what you do? What are some of the skill sets? What are some of the biggest things that you've learned? I know this is a very long-winded and multi-tiered question, so if you need me to state it again, no problem. But I guess, what are some of the biggest things that you've learned so far? What are your background from a school perspective, and some skill set and intangibles that people need in order to be successful in a position like yours?
Yeah, so I mean, just starting off with my background. So I graduated from University of Washington. I studied finance and entrepreneurship with a minor in real estate. And I would say I kind of like to think that a lot of the skills and everything I learned started in college, and it was really just having the mindset of, I think it's really, really important to network. And I started out in college thinking, I feel like fairly similar to Rob as well. I was initially interested in the stock market and working in public equities and things like that. I worked as a portfolio analyst for the summer going into my senior year of college. But I would say throughout college, I just tried to keep an open mind how can you really know what you're going to do at, 18 to 20 years old? Some people do. But I think it's really just important to keep an open mind and get out and talk with as many people as you can. And those skills translate especially well into real estate. I mean, I feel like everything I've been talking about, in a way, reaching out with brokers and things, developing relationships, that it's very similar to networking when you're trying to have a coffee chat with someone in college and trying to learn about what they do. And I think those skills really translate over to real estate specifically a lot. And it's a great way to learn. And ultimately it's a relationships driven industry. And so I think that's a great way to start. And then ultimately, I think real estate is compared to a lot of other fields, it's fairly difficult or it's not taught super well in the classroom. And so you're going to learn a lot just by doing. And I feel like I learned a ton just in the first few months, working at Lone Star. I started out just, underwriting deals, learning how to underwrite, and just being willing to put your head down, and just absorb as much information as you can. And, especially just being willing to lean into complexity. We've been learning a lot more about affordable housing programs. And, right now we've been looking into even, potential bond programs, low income housing, tax credit programs, things like that. And although it may seem complex in the beginning, I think ultimately, what Kent said the other day, which I think really resonated with me, is where there's complexity, there's opportunity. And I think if you apply that mindset just to whatever you're doing, it's going to serve you well, because there is a lot of opportunity in real estate. It's, in private markets and things, it's a little bit less efficient of a market than, say, stocks, where you've got all your information available on a day-to-day basis. So yeah, I mean, that's the long-winded answer, but yeah, hope I covered everything there.
Yeah, you did for sure. So kind of what I'm hearing there is just, and if I summarize this well, and please fill in the gaps, but you're going to learn slowly, baby gaps filled in, keep an open mind, always networking. And, I think one thing that you've been really, really amazing at, and I'll shout you out here, and I talk to Rob about this all the time, is you have a very, very great attitude about everything. I don't like, similar to myself, I would say you're probably a little more consistent than I am. I get a little higher and low. But you always have a good attitude, and you're always willing to pick up, and are very resourceful and helpful. And that does really go a long way. So for anyone who's trying to get into a firm, to be helpful and to have a good attitude, I think just those things you can always control. So you've done an impeccable job at, inserting that into your day to day, which has been really useful. Every single time I call you, you always are right on it, and will get me a great answer that is not only accurate, but you're very prompt to doing so, which makes my life a lot better. I'm sure, Rob, you've noticed I don't ask you as many questions as I used to for underwriting stuff, which is nice for you, because it's kind of, we all work and come together. So it's just been very beneficial to have you on the team, and watching you grow has been really fun. And a little backstory, I don't think I got into this, but Brad is also a Bay Area guy. He's a Menlo Park guy like myself. Rob's an Atherton guy. He's too cool, but Menlo Atherton is kind of its own sub pocket together. Palo Alto is its own entity. Menlo Atherton is a little bit more closer. You can kind of put those together. And we actually were on the same Little League team, albeit I was a little bit older, but I actually sold Brad's brother Taylor property. Shout out to Taylor, our boy. And then my dad, I don't think he coached you, but your dad was a lot of coaching for myself with Little League and stuff. So it's just funny that Lone Star Capital, as I said, with Dasha being on the firm and whatnot, it really is, it feels like a family business. And, there's very, very rich and deep ties associated. I think everyone feel more comfortable. So it's pretty cool.
Yeah, definitely. I appreciate the kind words, Craig. And yeah, been we've got a great team. Been great working with you as well.
Yeah, cool. Any final thoughts while we're on here? Any takeaways from Texas? Anything that I should be aware of? Have you done the Riverwalk yet in San Antonio?
No, that's on the to-do list. I think we'll do that tomorrow.
Have you spotted Victor Wembanyama yet? He would not be very difficult to miss.
We did find out where all the Spurs live, so we're getting closer.
Gotcha. Okay. Any final thoughts before we wrap up episode 13 of the Capital Spotlight podcast?
Is it episode 13?
Yes.
All right, very cool. Well,
Lucky 13.
Yeah, lucky
13, 14. Yeah.
Yep. Well, that 13's a quarter, so that's kind of has breezed by. Well, that's pretty cool.
Yeah. Well, final thoughts here, just to wrap up. If you are looking to invest or learn more about our opportunities, reach out to myself. My email is craig@lscre.com. Once again, craig@lscre.com. Simple enough. Thank you for those who have been messaging us. There's been a lot of really kind outreach and support, which is great. At first, it was a little bit choppy, but it seems as if we've ironed out the kinks. But criticism, comments, love, everything between, please send it our way. That is the only way for us to get better. Next week, we'll have a mailbag episode as well, because there were some questions that came my way that I'd like to get to the bottom of and ask directly from to the man himself, Rob. Finally, as I said, if you're looking to invest or to learn more, reach out to myself. If you're looking for more information regarding our event coming up October 15th to 17th at the One World Trade Center, which where our office space is, please reach out to me as well. It'll be a great way to network, to meet the entire team, to meet some of the best and brightest in the business, all in one space. So any questions regarding that, please let me know. Once again, thank you so much for the support of this show. If you find this information useful, or if you know anyone who you would like to listen to the show, please send it their way. And if you want to leave us a review, a like, a subscribe, all that good stuff, please do so. It does mean a lot to us. Thank you so much for listening, and we'll catch you next week.